time in the market is more important than trying to time the market. And, you don't have to be a super stock picker in order to benefit from stock market investing.
Black wealth is growing, but here's the challenge. The racial wealth gap, it's still massive. According to Brookings, the median gap between Black and white households is about $172,000, and more than half of Black families have less than $41,700 in total wealth. So the big question is, how do we close that gap? Well, that's what we're going to talk about today with Chris Wilson. He is the author of How to Make Your Nest Egg Last a Lifetime. Chris, welcome.
Hey, Bob, thanks for having me.
Pleasure. So let's start here. I want to not only help people figure out how to build wealth, but how to create generational wealth that they can pass down. So as you think about, in your experience, what's the biggest obstacles that people of color face when they're trying to not only build wealth, but also build generational wealth?
So let me first of all start by giving you a little about my background. I am a tax professional. I work I own a chain of H&R Block stores in North Carolina and Virginia. 14 stores. We do roughly 12 to 13,000 tax returns annually. So we see a lot in terms of dealing with the America's tax returns, and a lot of our clients are repeat clients. And so I have a front row seat to the good, the bad, and the ugly, if you will. And what I'm seeing in my community, the African American community, is number one, we don't start with the same numbers as other communities. Number two, we're not familiar with and therefore not comfortable with investing. And we're being led more and more toward the annuity product. And the annuity product is being sold as, hey, it's guaranteed income for life. You don't have to worry about volatility in the market. That's a bad thing. That's what we're always told. And I get it, guaranteed income for life is kind of like comfort food. And so it's an easy sell for the African American community, particularly when you don't really know a lot about investing and the ins and outs of stock market investing.
Yeah.
So we end up going down that annuity path. And when you do that, you turn over your income for a fixed monthly amount. You turn over your life savings for a fixed monthly amount, and that amount doesn't change. And going forward, you're okay for the first year, maybe 3 years in retirement. But 5, 10 years into retirement, now you've got to figure out how to make ends meet. You got to get creative. And all of that's based on the fact that you made a decision at retirement to go with the annuity. And that is causing you not to be able to maintain your purchasing power as you live longer into retirement. Most of us will live 30 or plus years in retirement. And so what I see in our community is that annuity trend. And it's not only in the African American community that's big on that, but is in particular the African American community is really navigating toward that annuity product.
Yeah.
And so I want to bend the arc in the opposite direction.
Yeah. So it sounds like if you were to sort of categorize the obstacle, it might be that one is there's a lack of financial education, a lack of financial literacy, but also a fear that comes from that lack of financial education, the fear of the markets, a fear of volatility, a fear of losing money in the market, et cetera. I mean, how does someone overcome? How do you become more financially literate? I guess where do you start?
So a good place to start is with an investment club. Those were pretty popular back in the 80s and the 90s, but I think I'd like to see them make a resurgent. And I think they're good tools for learning and earning as you go. It's easier to put an investment club together now with, technology being such as it is. You can pull a group of folk together from anywhere in the country or even the world for that matter and create a monthly meeting where you get together and learn about investing and pool your money and invest in stocks. And if you can do that over a good period of time, by the time you get to retirement, you've got a pretty good understanding of how the market works. And you put that up against the fact that if you don't do this and you get to retirement, you've got this big bucket of money that you got to make decisions with at retirement time. That's a pretty dangerous place to be without any knowledge around how to deploy your nest egg in order to have it not only sustain you for a lifetime, but to be a legacy for the next generation.
Yeah, you're right about investment clubs. They were very popular at one time, and I'm drawing a blank on the actual name of the book, but there was a women's group, maybe a knitting circle or something to that effect.
Bearstown ladies, I think
Right,
they're a pretty popular
and they
group.
had a
Yeah.
popular book, and starting an investment club, I think, is actually an interesting place to start, in part because not only are you investing, but you also have to learn how to research what you're investing in and to make presentations. So you're learning about analyzing balance sheets and cash flow statements and income statements, et cetera, and then making a case to your fellow investors that what you're proposing would be a good thing for the club to invest in. So that does seem like a great place for people to start.
It's never been easier, particularly because of all of the tools that are available to you now. If you want to do research, you've got a wonderful tool in AI that will help you not only research and compare and do that almost effortlessly. Um, but you got to the nuts and bolts of starting an investment club are around. You got to establish a partnership. What I do encourage folk to do is to determine what you're going to invest in and the types of investments you're going to be involved in before you and put any money into the pot. Um, Figuring out your investment objectives early on can just really help you have a smooth running investment club to where everybody knows what you're trying to do. You don't have somebody who wants to do real estate and somebody else who wants to do stocks. Figure that out up front and work out all of those types of details, and that makes for a smoother running investment club operation.
Yeah. So in addition to investment clubs, I had a chance to sort of peruse your LinkedIn profile before we talked today. One of the things that you noted that is that building wealth doesn't have to be complicated. Talk more about what you mean by that.
Yeah. So time in the market is more important than trying to time the market. And, you don't have to be a super stock picker in order to benefit from stock market investing. The thing I'd like to recommend for those who don't want to spend a lot of time trying to be a stock picker is to just go with the S&P 500. It has a historical return rate of slightly more than 10%. It beats 90% of the investment advisors on an annual basis. So um, I think that's a pretty good return considering that you don't have to invest a whole lot of time in trying to figure out which stocks to invest in. The S&P 500 gets you the elite companies, US companies. All of those decisions are made for you. It's kind of like being in the NBA, only the elite players get to play. And when you're past your prime, you got to go. So all of that's done for you in the form of the S&P 500, and all you got to do is just buy it, hold it, and know when to allocate it differently.
Yeah. So you mentioned the average annual return of being slightly north of 10%, but obviously it's the stock market, so it does go up 10 or up 20 or down 10 or down 20% in any given year. And you mentioned that people of color have a maybe a behavioral finance issue with risk. So how do you help people understand that there's a trade-off, that the greater the potential return, the greater the potential risk, and that calculated risk is worth it, especially over the long term?
Well, I first try to help them to understand that doing nothing is risky as well. That it is just as risky as, the volatility of the stock market. And you have to help people to understand that, the cost of eggs today is going to be different from the cost of eggs 5, 10 years from now. And if you don't have any money working on your behalf, then your purchasing power is going to erode. Um, and so I try to make that point and bring that home. And I also work with just the lifetime, the history of the S&P 500. If you can show the chart of the S&P 500, it does show yes, there is volatility, but it is volatility in a northeastern direction, if you will. And so, if you can be patient enough to buy it and hold it, and as I said earlier, investing and being successful in the market is about time in the market, not necessarily timing the market.
Right. So it seems to me that investing in a large capitalization index fund like an S&P 500 is a good place to start. Obviously, the tenets of investment planning suggest that you might diversify your assets, maybe small cap, mid cap, maybe value and growth, et cetera. Any thoughts about how one would sort of broaden the horizons beyond the S&P 500?
So, to keep it simple, I just focus on the S&P 500. And as you move through the life cycle, my recommendation is to just change the allocation. When you're younger, you would be weighted more heavily toward the S&P 500. And as you get older or you get to the retirement point, I would say pare back to fixed income type um, vehicles, such as, bonds or interests or something that will get you at least 4% on 70% of your money, and then keep the other 30% exposed to the S&P 500. I've got a model that I follow that I've developed called the North Star Nest Egg Legacy Model. And you can go to my website and download that model. And I've time tested it back from 2010 up to 2024, using that 70-30 evaluation, that model. And you do have a couple of years in there where the S&P did not, have a gain. It had a loss. But you can see over the last 3 years or so that there's been more than 20% growth on the S&P 500 year over year. But that's what keeps it simple. And I don't want to I don't want to, get too complicated with the model. And so that's why I kind of, instead of diversifying into small cap, large cap, let's just kind of work with the allocation and
All right.
make that work for you.
All right, Chris, we're going to take a short break. And when we come back, I want to talk about a different kind of investment opportunity with you. So don't go away. Welcome back to Decoding Retirement. I'm speaking with Chris Wilson. He's the author of How to Make Your Nest Egg Last a Lifetime. Chris, when I was reviewing your LinkedIn profile post, one of the things I noticed was that you're a fan of something called opportunity zones. A lot of people may not be familiar with what they are and how someone might invest in them. Tell us why you're such a fan.
So opportunity zones is a fairly new tax break opportunity, in that there are opportunity zones around it that have been identified across the U.S. map, and those are some of the low income areas or the poverty stricken areas that you can go into and identify those areas that are opportunity zones that you need an incentive to go in and invest. Now, if you take capital gains and if you have capital gains as a result of selling stocks or whatever, and you want to avoid paying the tax on it in the year that you sell it, you can invest in an opportunity zone, maybe in real estate, identify an opportunity zone, set up a company, invest in it, and avoid paying the capital gains tax on that for the first year. But also, after 10 years of investment in that opportunity zone, you can cash out tax free, without having to pay the tax on any gain that you get as a result of the initial investment. Now, you still have to pay the tax on the capital gains, but you get it delayed for a year. But any capital, and you have to hold the investment for at least 10 years. But then after that, you can sell it, and you can benefit by a tax-free sale.
Yeah. It sounds a
So,
little complicated on the face of it. Does it take a lot of money to get into one of these opportunities?
well, you can take, let's say if you wanted to buy a rental home in an opportunity zone, if let's say you made maybe $100,000 in capital gains, you could take $100,000, put it into a rental property. Now, you could put other money with it as well, but you have to kind of self-report how much of that was capital gains, and on your taxes each year, and go at it that way. So it doesn't take a significant amount of money to get involved in it, but it does require that you have a gain of some sort that you want to avoid the tax on.
The other LinkedIn post that I read was also interesting to me around what you call a magic mortgage strategy, which enables someone to fund their college tuition, which sounds kind of unique. And walk us through that.
Okay, so this is a model I actually use myself. It's when you're starting a young family, if you buy a home, and you start to grow your family, my suggestion to you is to, and I advise my tax clients of this as well, to take a 30-year mortgage, pay it off in 15 years, and use what would have been the second half of payments to fund college tuition. And so the reason you take a 30-year mortgage is because often there are bumps in the road, and if you have to revert back to the lower payment for a period of time, you can do that. But as soon as you can, get back on track on the aggressive path of paying it off as quickly as you possibly can. And then you can use what would have been the last 15 years of mortgage payment, to fund college tuition for your children. Like if you pay your mortgage off in 15 years, well, by that point, you got a 15-year-old in the house. Um, College doesn't start until 18, so you get a 3-year head start on saving, and then you can fund, with what was the mortgage payment, the the uh, um, the annual tuition payment. You can make the tuition payments out of what would have been the mortgage rate, and by doing that, you're redirecting what would have been $200,000 or so in my example, from interest payments to actually mortgage, or not mortgage, but college tuition.
Yeah.
Um, it worked well for us. Both of our kids went to out of state schools. We were able to use that model to fund their college tuition, and there were no student loans and college debt or anything like that to deal with as a result of doing that.
Right. So you've also noted on LinkedIn too that you've called the mortgage interest deduction one of the most valuable tax breaks out there. So on the one hand, you're accelerating your tax deductions in order to create this college funding strategy. Talk more about why you think that this interest deduction is so valuable, especially in light of the fact that with the one big beautiful bill, we now have increased standard deduction and the ability for people to itemize is well, depending on who you listen to, could be much improved if you have a large mortgage interest payment versus someone who might have a smaller one.
Yeah, I I think you should really focus on paying your mortgage off as quickly as you possibly can. But while you do have a mortgage, particularly in the Northeast and areas like the Northeast or California, they just recently adjusted the mortgage, the SALT levels from 10,000 to 40,000. So that gives you a lot of relief there. So you take your mortgage interest along with your other state and local taxes, and that gets you up over the threshold for the itemized deduction. And then once you get there, everything else that you could do, you could take advantage of from an itemization standpoint, falls into play there as well. But I do encourage people to, take advantage of, if you're paying your mortgage, look to itemize if you can. But don't use that as a crutch to keep your mortgage and your mortgage payments around just because it's a really good tax deduction.
Right. So speaking of taxes, Chris, I'm sure you've witnessed many more taxpayers increasingly filing for extensions. What do those folks need to know when they're doing that?
An extension to file is not an extension to pay. Uh, that's the most important thing. So if you're going to file an extension, you want to estimate about what you owe and make that payment as soon as you can, because Uncle Sam's comes calling, and if you haven't made any payments, you're looking at penalty and interest, and in addition to the tax that you owe. So
Yeah.
that's the main thing. That's the main thing.
Yeah, and I'm sure that when folks file their extension, they need to know that they shouldn't wait until the last deadline, right? October 15th, is it? Give or take?
October 15th, and in our area, due to the hurricane, we had an extension in the North Carolina area, had an extension to September 25th for the individual. But if you file an extension, you still get until October the 15th
All
to
right.
file. So it's a pretty busy time right now in the tax office, as people who have just kind of procrastinated are now having to face the music, so to speak.
Yeah. So speaking of facing the music, we have about a minute left, and if you could maybe just boil it down to one or two steps that folks, brown and black households, need to do in order to not only create wealth but to create generational wealth.
I would start with, the Trump accounts are new this year, where if you've got a newborn, you get $1,000 put into a brokerage account on your behalf. I would start with that. Even if you don't have a newborn, I would get a brokerage account for your children. As soon as they have a Social Security number, they can have a brokerage account. And I would recommend funding that brokerage account throughout the child's life. Add to it for birthdays, for special occasions, or whatever the case might be. Help the child learn, pick a stock that the child is interested in. Get them acclimated to being an investor, early on in life, and so it won't be something that they have to learn later on. So that would be my advice to families who wanted to kind of bend the arc in the opposite direction, and hold on to your retirement nest egg. Don't turn it over to anybody else.
That
That's what I would leave you with.
All right, Chris, that's really great advice. I want to thank you for sharing your knowledge and wisdom with us today. It's so greatly appreciated. Thank you.
Thank you. My pleasure.
So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to better plan for or live in retirement. And don't forget, you can listen to Decoding Retirement on all your favorite podcast platforms.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.